So, John, happy Monday.
Hey, Kerry.
Hey, so we're looking at, well, first of all, gold's getting killed today. It's under 1,200 for the first time in like years, under 1,200 per ounce. But how much longer that will last is a good question. But first, let's answer a couple of your questions out there, and then we'll get to the issues of the day. So Tom sent us one. He's a regular listener here and regular writer, and love you guys. Just figuring out my strategy for the future. And he wants to know about paying down debt. He's concerned that those who become debt-free will be means tested based on their debt-to-income ratio and face a higher tax burden and less Social Security benefits. And honestly, I don't know about you, John, but I've heard nothing to that effect dealing with people's debt-to-income ratios and Social Security.
Well, when governments run out of money, they do crazy stuff. And that's, a conceivable event on the list, but it does seem less likely. I think if you're debt-free, you're kind of under the radar. You just don't come to people's attention that much. But if you are debt-free and you have a lot of assets, there's a real possibility of wealth taxes and maybe even confiscations when things really get crazy. And that's, I think, the big risk. If you've got, for instance, a house above a certain value or a stock portfolio above a certain value or any other kind of asset that makes you stand out, then you'll become a target. If this goes to the logical extreme, a major financial and currency crisis in which governments are absolutely desperate for revenue because inflation isn't working for them anymore because we figured it out and we're front running them, then it's possible that they shift gears and start applying wealth taxes to people. Or if you own something that's going way up, for instance, if you own gold and silver and they're just rocketing, there's a historical precedent for that called a windfall profits tax that was applied to oil companies back during the 1970s oil crisis. And that's a possibility with precious metals. As a prelude to going back to some kind of a gold or silver standard, where they say, you know what, you've got all this money, all this gold and silver, and so many people don't have any. And you're making so much without doing anything. So we're going to take some of that away from you. That's completely possible. And in the 1930s, we flat out banned the ownership of gold for American citizens. So we've got a historical precedent there too. But the important thing to understand is that governments become unpredictable, as anybody does, when they're under extreme pressure. And the stress of what's coming is going to be immense. We've probably never seen a financial crisis like what today's numbers indicate is possible, if not probable. So expect government to do things that are commensurately extreme because the numbers are just so extreme now. So the way you deal with that is diversification. We can't predict exactly what governments are going to do. So it makes sense to spread our bets around a bit, have some precious metals on hand, have some stored overseas, have some real estate here, maybe some overseas. Everybody wants a Costa Rican beachfront condo, right?
Yeah,
and it's not a bad idea from the point of view of financial diversification too. So the fact that we can't predict what's coming means that discussions like this they're not exactly academic, but they aren't all that helpful either, just because we really can't know what these guys are going to do. And we can't know which country is going to do what either.
Yes.
So diversification is the best way to approach something like this.
Yeah, agreed. And even perhaps some international diversification, but I just think it's going to be so crazy in the rest of the world because it's going to come to the U.S. probably last. I mean, that just appears. You see these currencies blowing up. We've seen 6 currencies blow up I think about 6, John, in the past couple of months. Iran, Turkey, which is also another question that we'll cover. Iran, Turkey, Venezuela, Argentina, and Russia. The ruble's gotten slaughtered in the past couple of weeks. I mean, it's Andy Hoffman always said the dollar would be the last one to go, and looks like he might very well be correct, you know?
Yeah. Oh, it does seem like the trouble is starting at the periphery, and it's moving into the core. You have to add Pakistan to the list that you named there too, because they apparently are having a financial crisis too. That's a lot of peripheral countries. Mm-hmm. And then add Italy to that list. You know, they're a borderline developing country now, and their banking system is a huge mess. And they've got a government in place that doesn't want to play the EU's games anymore. So they're potentially going to join this list in the not too distant future. And you're right, we will seem really safe compared to these other places that are absolutely imploding. But remember, our banks have lent a lot of money to these guys. They have a tremendous amount of external dollar debt that hedge funds are on the hook for too. And, so we're not immune to this. The way these crises have tended to work in the past is they start with the most vulnerable. In this case, it's peripheral countries with a lot of external dollar debt. And then they move inward toward the core. And we're absolutely not immune to the crisis. Eventually, it takes a little longer to get here. But when it hits, 2008, 2009 was a near-death experience for the U.S. financial system. We didn't sail through that. We had to do really extraordinary, experimental, desperate things to prevent a 1930s style Big D depression. And in the ensuing decade, we've added so much new debt. I think globally, if you calculate debt comprehensively, we've doubled our debt. And the U.S. has doubled its government debt along with consumer debt and credit card debt and corporate debt, et cetera, et cetera. So we're more vulnerable now than we were back then, which means the crisis, when it hits, could be commensurately bigger. And my point is that we can't know what kind of response each government in each country is going to have. Some of them are going to do one thing, some will do other things. They're all going to do things that we consider aggressive and desperate and extreme because that's the nature of what's coming. But the fact that Pakistan blows up first and then the U.S. blows up later doesn't mean that you sail through with all your assets intact if they're all in the U.S. I still think international diversification is a good idea if you can do it. And if you can't do it, then you want to diversify among real asset classes. That is not financial assets. Don't be involved with government bonds at all. They're no longer safe, even though they might perform really well while the dollar is the only currency game in town. Eventually they blow up too. So you want to be in real assets that governments can't create more of, and therefore those things will rise in price relative to the fiat currencies that we're going to have to inflate away one way or another. Probably the end game here, the best case scenario end game is a global currency reset. The worst case is obviously some kind of geopolitical thing where we have a financial crisis that leads to war and then all bets are off because the weapons today are incomprehensibly powerful. But barring that, we'll have some kind of a global currency reset where we just recognize that these fiat currencies don't work anymore and we'll go back to some kind of a commodity-based standard or some other rule that prevents governments from creating more currency than population growth. In other words, it limits currency growth, the growth of money supply to 1 or 2% a year. And we can't know what that rule is going to be. We can't know how it'll be implemented. It could be a gold standard. It could be Milton Friedman's computer that only spits out 1 or 2% more money each year, but something like that is going to happen. And it will be preceded by a huge devaluation that will help real assets and hurt financial assets. So that's the kind of diversification that you want to be looking at among real assets. A little bit of real estate, some precious metals, some energy-related stocks, a few other commodity stocks, things like that. They will tend to do well. Government bonds, money market accounts, and bank accounts won't do so well at all.
Mm-hmm. Yep. No doubt you're right. And that leads to the next question from Jesse, also a regular on the show, writing to us. I'm awfully confident the Turkey lira currency collapse is on the top of the list for John, but if for some insane reason, Erdogan refuses fiat from the IMF, who else may see an opportunity to come to the aid of Turkey? And if that happens, what would be the response of the West? And then he's got another burning question, involves Canada, the country of peace. The story just kicks me in the you-know-what. Hard to believe they angered the Saudis that much. Anyways, the Department of Finance sold off all of the government's gold reserves way back in 2016 and holds nothing but yen, sterling, euro, and dollars. Loonie hasn't gone to zero, right? So why shouldn't the Fed just sell off their gold reserves? So let's get back to the first. So we kind of answered it, but is there going to be a white knight for Turkey that comes from outside the West, like maybe China or Russia?
Well, see, that's what's so bizarre about the Turkey situation. They're a NATO member. They're part of the military alliance that is aimed at Russia and China. But they made the mistake of borrowing immense amounts of U.S. dollars. They have the biggest external dollar debt relative to GDP of any of these emerging countries that are blowing up. And with the dollar going up, that makes those debts harder to manage. And at the same time, we've got this geopolitical thing going on where we're imposing sanctions on them because they have arrested an American priest or something like that. And
right.
That's making it harder for Turkey to manage these debts, which would be a crisis for them regardless. And it's completely possible that China or Russia step in with some interim loans. But then, the whole NATO thing becomes an issue. And does Turkey leave NATO and join some other military alliance, or do they become non-aligned? Or there's no way to know how this plays out. But none of the scenarios are happy ones because they have too much debt. See, that's the overriding theme of all of this, is that when you borrow too much money, you lose control of your life. And these emerging countries that borrowed too many dollars are finding that out big time right now, as are the European and American banks who lent those dollars. So we're not immune to this, but Turkey is a situation that can go a lot of different ways, but none of them are positive.
Mm-hmm.
So we'll just have to see how this plays out. But yeah, it's completely possible that that our relationship with Turkey sours to the point that they turn to some other country, and we get the beginnings of a realignment, geopolitically as well as financially. And who knows? That's long-term bad for the dollar, right? And the Saudi Arabia thing is also a big deal because the Saudis are huge creditors of the U.S. and they're the linchpin of the petrodollar system. In other words, if they only take dollars for their oil, then that means the dollar has this huge role in the global financial system that it might not have otherwise. And if the Saudis get so frustrated with us that they start diversifying and say, well, we'll take rubles, we'll take yuan, that's a big change in the global financial system as well. And it's one more thing that is weighing on the dollar long term as other countries start trading in their own currencies and lessen their need for dollars as a reserve currency. That's one of the things that when the next crisis hits, we'll look at and go, oh, we have this big problem we didn't realize. Nobody needs dollars anymore for trade. And that means they need fewer dollar reserves, and that means there's less demand for dollars. It goes on and on like that.
Mm-hmm.
With the end, point being some kind of a dollar value crisis. And that's out there. Hard to say when it'll happen, but it does seem to be coming.
It certainly does. Well, my theory here about what's happened with Canada and Saudi Arabia is if Justin from Canada wasn't on the outs with Trump, none of this would have ever happened with Saudi Arabia basically cutting the cord. I think, I don't want to get all conspiracy theory-ish on you there, John, but I just find it really interesting that the enemy of Canada is our friend, the good people of Saudi Arabia, right? I just find it all rather funny and not just a coincidence. I don't think this would have ever happened if Trudeau hadn't dissed Trump. But this is payback. You know what they say: revenge is a dish best served cold.
Yeah, I wouldn't put it past Trump to do something in that kind of a roundabout way. And you wouldn't expect Saudi Arabia to do what they're doing without some kind of a tacit okay from the U.S., because it's a fairly big deal, Canada is a major ally of ours in every way you want to look at it. Militarily, financially, geopolitically, they're on our side most of the time. Mm-hmm. And Saudi Arabia is, while it's a very different system, is still a major ally of the U.S.
Very much so.
We work with them in lots of different ways, good and bad, and they're considered very valuable by pretty much every U.S. president since the Eisenhower administration. Yeah. So this kind of thing is just one more thing. There's so much crazy stuff going on out there. There's so many weird things happening that that have come out of left field. Turkey blowing up was completely surprising. Nobody 3 years ago thought that was going to happen. And now Russia completely dumping their U.S. Treasury bond holdings is also a very big deal. And Saudi Arabia disconnecting itself from Canada, that's not such a big deal in terms of numbers, but it's just psychologically weird. It changes the tone of geopolitics and global finance in a way that adds to the impression of a lot of people that the world is getting darker and scarier.
Yeah.
And market psychology is all important in a fiat currency system, because these currencies aren't backed by anything except our trust in the people who are managing them. We have to think these guys have it together, best interest at heart, or why do we bother with these currencies? Well, that sense that we can trust these guys to know what they're doing is eroding every time there's a new announcement like this.
Very true. Very, very true. And this thing just seems, the permutations on it, and the craziness of it, it seems like, control's being lost here. And hey, we'll just have to see what happens here. I just don't know where this is heading. I'm the first to admit it, but it's definitely knocking the hell out of gold and precious metals temporarily, because the dollar is just, the dollar has become this thing. Remember that thing? It was like on Star Trek, and it ate universes. It was like looked like a barrel almost. And it was looking around, searching for universes to suck in and destroy. And that's what the dollar is like almost become now,
Well, yeah, a strengthening dollar is a really dangerous thing for a lot of people. And that's part of the cause of the emerging market crisis, because they all borrowed so many dollars that they now have to pay back, but they have to pay it back in stronger dollars, which means it's harder to do, and they can't do it in a lot of cases. And yeah, that's part of what's weighing on gold. Although, God, Kerry, you would think a world that's getting progressively crazier like this would be good for gold and silver. They're the safe haven asset historically. And they aren't recently that. But a lot of other things in the gold market have gotten really positive. We talk about the Commitment Traders report here once in a while, and last week's report was extraordinary. The speculators are almost flat, which is really unusual. Usually the speculators are long. And the commercials, who take the other side of speculator bets, are also almost flat. Usually they're short. So we're seeing the market in the futures, at least, in the paper markets, go to a position that is historically really positive for gold and silver. When you flush out all the speculators and they turn negative, that's usually a sign that we're at the bottom, because the speculators tend to be wrong at big turning points. When they're convinced they're right, they're wrong. And they're convinced that gold is going down right now. At the same time, we've got seasonality starting to kick in. The spring and summer are bad for gold and silver because that's not when Asians buy their gold and silver. The fall and winter are when they buy their gold and silver. So we're heading into that time. So we're at a point where you've got the paper markets looking really positive for gold and silver and seasonality at the same time. Last time we had this was late 2000. Early 2016, like January 2016. And we had this great 6-month run in precious metals and the mining stocks. So we're lined up for something like that again, according to these indicators.
Correct.
Which is to say, if these indicators still work, good things are coming. But indicators don't always work, and they don't always continue to work. So it's not a done deal. It's not a guarantee. But if historically useful indicators are still useful, then gold and silver ought to do much better in the next 6 months than they did in the past 6 months. And that ought to carry over to the mining stocks.
Yeah, definitely should. Agreed. Hey, so a lot of unrest, though, in the world, a lot of uncertainty. But right now, nobody's shooting at anybody, pretty much. No hot wars, right, as a result of it?
So far. I mean, there's a lot of shooting going on in the world.
But there's always shooting, right?
Yeah. But nobody big is bombing anybody else big right now.
Right. Yep.
Though there's a lot of saber rattling going on, and there's a lot of positioning going on where, it's conceivable. In Syria, for instance, we're shooting at people who have Russian advisors, and the Russian advisors are engineering attacks on our allies. And so we're bumping up against each other there. And same thing in the South China Sea, where we're not the same thing, but also scary is the South China Sea, where China is claiming big chunks of that, and the rest of the world disagrees. And we're sending fleets in there to contest China's claims that they own all these islands and things in the South China Sea. And that's an easy thing to screw up, where somebody panics, somebody makes a mistake, somebody shoots at somebody else. And so you hate to see stuff like this, because it's so potentially dangerous with today's weapons. We really don't know how these weapons work. Hypersonic missiles, what are you supposed to do about something like that? Or autonomous drone, nuclear armed submarines. That's the kind of stuff we're building.
You better duck and cover, is my advice.
And then autonomous robots and things like that.
Yeah, that make the decision to
kill. We're building Terminators out there.
And they make the decision to kill.
They get to decide who to kill once they're out there. So this is the kind of world that we should be going out of our way to avoid conflict in, just because conflict is so unpredictable and potentially devastating. And we're not doing that. We're picking fights with people almost randomly. That's really scary.
Seems that way, doesn't it? Well, hey, I find the COT report definitely a portent of things to come, because, like you said, the specs, as we call them affectionately, always get it wrong, and the commercials almost always get it right. I mean, I can only think of one or two times, and they were they played out so quickly, you couldn't even catch. It was a falling knife. So I'm inclined to agree with you, John. We're probably at the bottom or close to it. Maybe they can knock it down another $50, get to the mid 1100s, but
Sure. You know what's happening today is that the speculators are being flushed out even further.
Mm-hmm.
So the next commitment of traders report might show a net short for the speculators, which is a really big deal. They were almost flat this time.
Yeah.
But if they go shorter, which it feels like they're doing right now, right? Somebody is selling big time, and other people are responding to it. So if the next report shows a net short for the speculators, that will be almost unprecedented. You just don't see that very often.
Yeah,
So
exactly.
again, if this signal works, it's screaming buy for gold and silver.
Yep. No, agreed for sure. No question about it. Yeah, if it works the way it has worked in the past, and it will probably keep working, then that's what we certainly can look forward to. And it would make a lot of sense that that gold would be bottoming just at that particular point, right? It just would make sense. But I don't claim to be the expert at prediction. You know, Yogi Berra always used to say, prediction is really hard, especially when you're talking about the future. And that's what we're talking about here. So let's see what happens next, John. Anyway, check out John's work over at dollarcollapse.com. We're at financialsurvivalnetwork.com. We had over 200 of you attend or watch the replay of our webinar last week. It's available. If you need the link, you can search Financial Survival Network. It's up there. Just put it up, webinar. John, what do you think of our guests there, Silver One and Mag Silver? Really interesting companies, huh?
They were good presentations. And those are the kind of junior miners that in the next upswing are going to double easily. And then the intellectual challenge becomes when to sell.
That should be your worst.
They could be 10 baggers.
Yeah.
They're among the good juniors. And good juniors are going to be extremely popular when the next cycle begins. So it's going to be hard to know when to pull the trigger once you've got an embedded profit in these things. That's a good problem to have, but it's still a problem. So we'll have to see how it goes. But I think those are both potential 10 baggers.
Hey, so here's a guy. I got this question back in June, and we half-assed discussed it, but I want to just cover it with you now. He doesn't think you were fair to GLD. Here's a quote from Pierre Lassonde a few years ago from, I guess, I don't remember what show it was on, but Eric King World, probably. Some people deprecate gold ETFs as paper gold, arguing that it has the same problems as fiat. How do you respond? Lassonde, I can only speak to the Spider Gold Shares, ETF, GLD, New York Stock Exchange, the instrument created by the World Gold Council. I was very much involved in its creation. The documents that establish it state clearly that every ounce of gold bought on the New York Stock Exchange must be backed by an ounce of physical gold. I've been in the vaults of HSBC, a fine upstanding bank, I might add, and seen the $60 billion in gold there. As far as the Spider Gold Shares ETF is concerned, these claims of paper gold are complete fantasy. SPDR Gold Shares is physical gold. It trades on the NYSE to make it easy for people to buy and sell. Before the ETFs, it was very difficult. So that's what Pierre Lassonde said. But when you look at the papers, the docs, right, the SEC filings, you see that the sub-depositories aren't necessarily audited and that they can hold gold in sub-depositories. Do I have that right?
Yeah, that's what I'm basing my criticism of them on. And this is from research done by James Turk, the founder of Gold Money,
right?
Who looked into it and found that GLD is allowed to farm its gold out to, as you said, sub-depositories, and they can't audit those particular vaults. So we don't have a clear chain of ownership necessarily there. And we don't know, therefore, exactly how much gold is backing each share of GLD. So I tend to trust James Turk. I've known him a long time. He's he's a detail guy. When you turn James loose on something like the prospectus of an ETF, he will spend the time that it takes to understand it. And that was his conclusion, that it's not something where everybody involved can go to a vault, see what's in the vault, and be able to measure the backing of the shares that are outstanding related to that gold, because you don't get to audit all of these sub-depositories. And, that's not the same thing as gold coins in your hand or allocated gold stored in a vault by somebody that does that for a living and has it completely insured, et cetera, et cetera. It's a different thing. So it's one step removed or several steps removed from actual ownership of precious metals, in my opinion. And it's a great trading vehicle. It's really easy to buy and sell. It does tend to bounce around in line with the gold price. But I think it's completely possible out there at some point when it really hits the fan that it's somewhat less safe than gold that you own yourself or that you've got stored in a place that is insured and audited regularly.
Yeah, I wholeheartedly agree with you. There's been too many where people thought other people were holding their gold and they weren't. Other depositories, whatever. They were in a trust type situation and it turned out didn't happen. That, oops, sorry, we issued too many notes and there just wasn't enough gold to back it up. And there's been too many governments, John, that have done it. So I'm wary of such schemes that are done for the convenience of the, you know what I'm saying, of the general public to make it easier for you to buy and sell gold. It's really not that hard to do if you're motivated, and it could be as simple as a trip down to the local coin store, the local neighborhood coin store, if that's how much quantity you're looking for here. So, really, what's
the important thing to understand is that these are separate ideas. In other words, owning gold that you have on hand versus an ETF that you buy like a stock, that they have separate roles in your financial life. The gold you own personally doesn't have a counterparty risk. Nobody else has to keep a promise for that gold to be there and to maintain its value. But financial assets that are linked to gold require somebody else to do something. So you're taking on extra risk in return for convenience with these things. It doesn't mean you shouldn't ever own them, but you should understand that somebody else has to do something before those things turn out to be what you hope they are. And so it's not gold. It's a way of tracking the gold price. It's a way of speculating on the gold price, but it's not necessarily a long-term holding that is at the risk-free core of your portfolio. That's something
exactly.
That's